Hello everyone and welcome to BDO's webinar on the new EU E-Commerce VAT rules. Today we're going to be looking at the impact of these rules for UK retailers. Just so you know, you're joined today by myself. My name is Richard Hogg. I'm a director in BDO's UK VAT practice. I'm based out of our Manchester office, but I work extensively with retail clients across the country. I'm delighted to say I'm joined today by my colleague Madalena from our Dutch member firm.
Yes, thank you, Richard, and happy to be here today. So my name is Madeleine Merks. I'm a partner at the Tax Research Center of BDO the Netherlands, which is based in Tilburg, and I'm also a professor of indirect taxes at Erasmus University Rotterdam. And also from the academic perspective, I've been studying these new rules since they were proposed by the European Commission. And I will be here today together with Richard to explain the rules to you. And if there's any questions, of course, we're also happy to take them as well.
Thank you. Thanks for joining us today. And it's really useful to get a European perspective on these new rules as well. So really appreciate you taking the time to join us. So just to give you an overview, the aim of this session today is to give everybody a very brief overview of these new rules. So the new EU e-commerce VAT rules are due to come into force with effect from the 1st of July 2021. So just in a couple of months' time. As I say, our webinar today is going to focus on the impact of these rules for UK businesses. As many of you on the call will probably be aware, UK retail supply chains have been under pressure recently due to COVID and due to having to adapt to take account of the UK's exit from the European Union. So what we've got happening from the 1st of July is yet more change, which potentially impacts on UK retailers. So what we want to do today is to help you to understand these rules and enable you to plan for any changes that may be needed. So the format of today, Madalena and I will present an overview of the rules, but we are very keen to allow some time for questions and answers from the floor. So if you do have a burning question about the new rules, please do reach out to us. And the best way to do that is through the Q&A tab at the bottom. Those will come through to us as we present today. What we'll try and do is in a few minutes at the end, we'll try and address some of the key questions we've had through that Q&A function. If we don't get time to do them all, I promise somebody from BDO will come back to you separately. Equally, I will just let you know now, for anybody who is taking notes or anything like that, please bear in mind that you will receive a copy of the slides and a recording of this webinar, which will be circulated to you tomorrow. So without any further ado, let's provide a quick overview of the rules. As I say, these are new rules which are due to take effect from the 1st of July. And they have the potential to impact anyone who is making B2C supplies. So that's supplies to a consumer as a UK business of either goods or services where that consumer is based in the European Union. The changes were originally due to come in on the 1st of January this year, but they have been delayed by 6 months due to COVID to enable member state readiness. If you've looked at these rules in the past, you may have seen some speculation of potential further delays. We can never say definitively, but to the best of our knowledge, these rules are going to come in from the 1st of July. What we've seen in recent weeks, for example, is the European Commission releasing fairly extensive guidance about how the new rules will work. Equally, we're seeing some EU member states start to open their registration portals for the one-stop shops that we're going to talk to you about today. Now, just as a quick observation from my perspective, we deal with a lot of businesses within the retail and e-commerce sectors. We've seen some businesses who are really well prepared for these, who are taking steps already to get ready for the changes. But overall, I think they've had a relatively low profile in the UK to date, for whatever reason, whether it's businesses focusing on their existing changes to supply chains because of the UK leaving the EU, or because they're not actively being promoted by HMRC here in the UK, for example. So the key message from us today is have an awareness of these rules and then use that awareness to understand if your business needs to do further work to prepare for them. So why are these changes being introduced? Well, it's for the three reasons set out on the screen there. Simplicity, tax neutrality, and to limit losses of VAT revenue for EU member states. So when it comes to simplifying the system, the European Commission will say, well, actually, do you know what? The rules are fairly complicated at the moment. And it's one of the main reasons why people don't trade cross-border. So what we're doing is we're going to introduce some new compliance scheme, one-stop shops, which will make it easier to manage multiple VAT registrations within the EU. Having said that, in reality, we think the other two boxes are probably the key reasons why the changes are being introduced. Because we're dealing with some fairly old rules around how businesses interact with consumers for VAT purposes within the EU, you find there are some scenarios where non-EU suppliers don't necessarily have to charge VAT on the goods or services they provide to consumers. Now, whether that's legally or illegally, there are various different approaches to that. But a competing EU business is probably going to have to charge VAT. So what the European Commission wants to do is to level that playing field so that consumers are being charged VAT regardless of where they purchase their goods and services from. Equally, if VAT is not being captured, EU member states are losing valuable VAT revenue because they're not picking up VAT on goods or services being provided to consumers. So what the new rules are trying to do is help EU member states collect VAT on the goods and services that are supplied to consumers in their country. And the overriding principle is that if you're selling goods or services to a consumer in an EU country, that supply should be taxed in the country where the consumer is based. There are exceptions to that, but that is the overall principle. So very briefly, what are the main aspects of these changes? And you'll see from the screen that there are 5 main changes which are coming in from the 1st of July. Firstly, the distance selling threshold is being abolished. For any retailers who sell goods cross-border within the EU, you're probably already familiar, at least in some respect, with distance selling. And the rules to date have largely said, well, actually, if you have a stock of goods in the EU that you sell to EU consumers in other member states, you tax those in the country where the goods are located until you cross a threshold. And once you've crossed that threshold, you have to register in the member state of destination and account for local VAT there, where the customer is based. A lot of the time, that threshold is €35,000, but there are some EU member states who are a bit more generous, like Germany and the Netherlands, who will apply €100,000. Those thresholds will go from the 1st of July. Secondly, there is a VAT exemption at the moment for imports of small, low value consignments into the EU. So if you import goods from outside of the EU into the EU, and those are valued at under €22, you won't have to account for import VAT. Again, that is being removed with effect from the 1st of July. So what else have we got? We've got the extension of existing one-stop shops to all other business-to-consumer supplies of services and distance sales of goods. At the moment, the EU operates a mini one-stop shop system, and some of you may be familiar with this. And this will be where you are selling digital services, so telecommunications, broadcasting, or electronically supplied services to consumers in various different EU countries. Rather than registering in each country where the consumers are based, what you're allowed to do is register in one country and file all of your EU VAT obligations with one EU tax authority, who will then pass on that VAT to the different member states where your consumers are based. So that scheme is being extended to cover more goods and more services from the 1st of July. Equally, there is a new scheme being introduced, the Import One-Stop Shop. And this is available for non-EU suppliers who are making supplies of goods to EU consumers under a certain consignment value. Like other one-stop shops, you'll register for VAT in one country and deal with all of your EU VAT obligations through that one tax authority. And then finally, there's special arrangements for postal and courier companies. And this is in place to help ease the collection of VAT, and it's linked to the Import One-Stop Shop. So as you'll see from this one slide, there are 5 changes, and it's quite wide-ranging reforms coming in. So there's lots of potential application for UK businesses. In practice, we think the most common impact for UK businesses is likely to be those who are selling goods to EU consumers. So it makes sense for us to start here. And at this point, I'll hand over to my colleague, Madalena, to explain the rules in this area.
Thank you, Richard. And like you said, it's good to start with the sale of goods coming from outside the EU, so from going from the UK to, for example, the Netherlands or a different EU country. What is changing, like already mentioned, the main change is that the import VAT exemption that is available for parcels with a value under 22 euros is being abolished as of the 1st of July 2021. So that means that basically every import of goods is subject to VAT in the EU country where it is being imported. Well, that of course causes both for businesses but also for the customs authorities that provides, that means that the customs authorities have to check each parcel and everybody has to pay import VAT. So at the same time, the idea has been to make life more easy for businesses and also for the customs authorities. So there have been, there are going to be 2 new arrangements: the importer one-stop shop and the arrangement for postal and courier companies to make it more easy to import goods and consignments that have a value of no more than 150 euros. So above 150 euros, you need to pay customs duties in the EU, and if it's 150 euros or less, you don't have to pay customs duties. So you would only have to pay import VAT at the moment of importation. So that is why these special schemes have been introduced to cover the VAT. And I will first explain them and then show in an example what options you have. So to start with the new importer one-stop shop, or IOSS, that's available for B2C sales of goods into the EU if the consignment is no more than 150 euros. And what happens there, that VAT is collected directly by the supplier. So at the moment that he makes the sale and the customer accepts the payment, he will automatically charge VAT to the customer, of course, but also he will need he needs to pay that VAT to the tax authorities, which he will not do directly, but there is a tax point at the point of sale. And he will need to charge and pay VAT of the country of the customer, so where the goods, where the goods arrive and in the country of the customer. At the same time, if you import those goods, there will be an exemption. So everybody that uses the importer one-stop shop scheme will get a special VAT number. And if that special VAT number is shown to the customs authorities of an EU member state, and that can be any EU member state, you will get an exemption on the import. So what happens is that you pay VAT on the sale and you don't pay any VAT on the import. This scheme, of course, allows for a faster clearance, because customs authorities will check whether you have such a special VAT number and whether it's valid. And if that is the case, you can release the goods for free circulation in the EU. It is an optional scheme, so you don't have to use it. You have the option to use it. You can also either choose a standard arrangement for import of goods or the arrangement for postal and courier companies. And what should also be noted, that if you're not established in the EU, you need to appoint an intermediary in the EU. And this currently does not apply if you are established in Norway and selling from Norway. And I know from some observations from our Dutch State Secretary of Finance that they're currently looking into whether the UK can also, whether UK businesses can also be released from the obligation to appoint an intermediary. But for the time being, you are required to appoint an intermediary if you are established in the UK and selling goods from there. So if you not choose to use the import one-stop shop, or you cannot find an EU intermediary, and so you're not able to use the one-stop shop, then you can also the arrangement for postal and courier companies can be used. It's called a special arrangement, and it also applies to consignments of no more than 150 euros. So this is being applied by postal and courier companies that will import those goods on your behalf. And what happens is that they, of course, will collect the VAT from the person for who the goods are destined. So that's normally the consumer in the EU member state of destination. And then the postal or courier company will need to report that VAT to the tax authorities. They do this in a monthly VAT return, and then they get a deferred payment until until the mid-month of the next month. It's also important to note that member states have the option to put a rule in their national legislation that states that if you use the arrangement for postal and courier companies, that the general VAT rate always needs to be applied. So that means that even if you have a product that falls within the scope of a reduced VAT rate, you will still need to apply the general VAT rate. Of course, as a customer, you're then able to say to your postal and courier company that you don't want to use this special arrangement, and they will use standard procedures for import VAT. So I can understand that this might look complex. So I think it's important to also use an example to show what the consequences are of these new rules. So we here have a UK supplier that is selling goods to both consumers in France and Germany. And as you can see, the goods will enter the EU in France, and from France they will be put on a truck, and they will be moving to Germany, as far as those goods, of course, are destined for German consumers. And yeah, you now have, as a supplier, you have two options. You either use the IOSS or you don't use the IOSS. So what happens if you use the IOSS? Then, of course, the import of VAT in France will be exempt from VAT. So you will not be paying import VAT in France. You do need to report VAT on the supplies. The supplies will be subject to VAT in the EU member state of destination. So for the French consumers, that's France. And for the German consumers, that's, of course, Germany. And you can report the VAT on those supplies in one IOSS VAT return. So you register in one EU country for this scheme, and then you can report the VAT on all supplies subject to VAT in the EU through that one single IOSS VAT return. If you do not use the IOSS, and then of course your imports will be subject to VAT in the EU member state where you are releasing those goods for free circulation. It is important to note that there's also a change in customs legislation that says that you cannot release the goods for free circulation in an EU member state different from the EU member state of destination. So in our example case, the goods enter the EU in France, but they're destined for German consumers. You cannot release those goods for free circulations in France, but you will need to put them under a customs transit procedure, and they need to be imported in Germany. And then for the payment of import VAT, either the standard procedure can be used or the special arrangement for postal and courier companies. And if there's an EU country that also allows for a VAT deferment license, it can, of course, also still be used. That is not being abolished. And then for the supplies, if those goods are being imported in the name of the customer, so in the name of the consumer, which is the perspective of the European Commission, that it's most of the times imported in the name of the consumer, then the supply will be subject to VAT in the country of departure of the goods, which is in our example the UK. So it will not be subject to VAT on the EU member state. So as you can see, if you use the IOSS, then you will pay no import VAT, but you will pay VAT on the supply of the goods in the country of the consumer. If you don't use the IOSS, the import will be subject to VAT in the country of the consumer, and you will not pay VAT on the supply in case the goods are being imported in the name of the customer. Of course, if you choose not to use the IOSS from a commercial perspective, that also means that your consumer, your client, is confronted with the import VAT. While if you use the IOSS, then he pays the VAT upfront, and he doesn't have an unpleasant surprise when the goods arrive at his doorstep. So we also want to briefly touch upon the situation where goods are being sold that are already located in the EU. So for example, if you have a stock of goods in one EU country and you sell goods to other EU countries from that stock. Yeah, like Richard already mentioned, in the current situation, we have thresholds in place. So that means that as a main rule, VAT is due in the member state of departure of the goods. And in this case, that would be German VAT. And then you have to check whether a distance selling threshold is crossed. So coming from the Netherlands, I always use 100,000. But of course, there are many countries that use a 35,000 threshold. So you need to see whether that's being exceeded or not. If the threshold is exceeded, then you will need to pay VAT in the country of destination of the goods, which in this case would be France. The key changes here are that those distance selling thresholds are being removed. So the good side of that is that you don't have to manage and check whether you cross the thresholds anymore, but you will need to pay VAT in the country of the customer right away. There is a very limited exception, though, which only applies to small businesses that are established in only one EU member state. They can, if they have, if the distance sales are no more than 10,000 euros a year, and that includes distance sale to all other EU countries, they can still charge VAT of the country of departure of the goods. This is not for businesses established outside the EU, and also it's not for a business that, for example, has its main establishments in the UK but has a fixed establishment in an EU country. Then it also doesn't apply. So it only applies if it's an entity that is only established in one EU country, which I think for most UK businesses will not be that relevant. Of course, now you have to pay VAT in other member states much quicker than in the current situation. So the one-stop shop is being extended to cover B2C supplies of goods. And we think that UK businesses that have a stock in the EU from which they sell goods to consumers in other EU member states are likely to find this beneficial, because then you don't have to register in each member state where you have customers and file VAT returns there, but you can do this through one EU country. And like it's shown on the next slide, for example, well, I here have a supplier that is established in Germany, but it could also be, of course, a UK supplier selling from a stock in Germany. What happens under a one-stop shop is that the supplier will pay the tax, the VAT, to the German tax authorities, and they will then distribute it, the VAT, and they will also forward the part of the tax return that relates to France. They will forward it to the French tax authorities. So the German tax authorities, in fact, collect the French VAT for the French tax authorities, and also, of course, when it concerns French suppliers or stock in France, vice versa. That was the slides about the EU distance sales and the distance sales of goods coming from outside the EU. I will now give the floor back to Richard to discuss services.
Thank you very much. So yes, right at the start, I said the most common impact for UK suppliers is likely to be those UK suppliers of goods to EU consumers. But that said, we shouldn't neglect the fact that there are important changes in respect of supplies made to EU consumers, where those supplies are B2C services. And what you might find is that UK suppliers of either telecoms, broadcasting, or electronically supplied services might already be registered to use a mini one-stop shop to report local VAT where their consumers are based. And what the new rules do is they extend that existing MOS scheme, the one-stop shop scheme, to encompass more B2C services. So what do UK suppliers need to think about if you are a UK supplier who's supplying services to an EU consumer? The key thing here is to have a look at what you're supplying to those consumers and to look closely at the VAT place of supply rules. Because the new rules will only impact services where the place of supply is the EU. So have a look if you are doing something which is not digital services, not telecoms, broadcasting or electronically supplied services, and you're supplying those to EU consumers, have a look closely at what they are and have a look closely at the VAT place of supply rules. Because as I say, the place of supply needs to be the EU to be caught by the new rules. And if the place of supply is the EU for a B2C supply of services, then a one-stop shop might be available to help you simplify the VAT accounting of those supplies. Equally, if you're a UK business making supplies of services to EU consumers, which are not digital services, it's important to have a look at where those services are supplied from. You might have an establishment for VAT purposes, for example, in the UK, and an establishment for VAT purposes in, say, the Netherlands, for example. It's important to have a look really closely where those services to consumers are supplied from. If they're supplied from the UK, it's likely that you'll need to use the non-union one-stop shop scheme. Whereas if they're supplied from the Netherlands, you'll probably have to use the union scheme. Now, what you'll see is there are a few brief examples on this slide, which just show you some of the circumstances where UK suppliers may have to report B2C supplies of services. So for example, up here we've listed provision of accommodation to EU consumers, valuation of work and goods is covered by the rules. But not all supplies of services, B2C supplies of services, are captured by the new rules. So for example, consultancy or accountancy services aren't, supplies of staff aren't needed either. So really need to be careful around those place of supply rules. And again, just to come back to the key message, if you're a UK supplier making supplies of services to EU consumers that are not covered by the existing mini one-stop shop scheme, have a look closely at those services. And we really recommend mapping out the supply chain to see if they're caught by the new rules and to see if you can benefit from using a one-stop shop scheme. This is probably least common for UK businesses, but well worth a look at if you operate in that sector. That's a very brief overview. I'll pass you back now to Madalena just to cover off some of the platform rules for marketplaces that are relevant too.
Yeah. So it may also so I'm also going to discuss what the rules are if either you are owning a platform that facilitates distance sales, or if you sell goods through such a platform as a supplier, because then the VAT consequences may be different. These are very complex rules, and I'm just gonna briefly discuss those with you. So if you think that you will be confronted with those rules, please take a good look at your position, and you can also, of course, also contact us for if you have questions about this. So what happens? So under the new rules, in certain situation, electronic interfaces or platforms will be the ones that are being are responsible for reporting the VAT on distance sales. And this is done by a deeming provision that states that if the provision applies, there's deemed to be a supply from the supplier to the platform, and subsequently from the platform to the consumer. In that case, the transport is always being attributed to the supply from the platform to the consumer, making that supply the distance sale. And the other supply is a supply without transport. The deeming provision applies in two situations. The first one being if it concerns distance sales of imported goods, so goods that have not been imported in the EU yet, and that have an intrinsic value of no more than 150 euros. Those are always covered, regardless of whether the person selling those goods, so the supplier, is established in the EU or not. In that case, like I said, the supply from the platform to the consumer will be the distance sale. So it will be the platform that reports this VAT in the IOSS if it has opted to use the IOSS. And the supply from the supplier to the platform is a supply without transport, and a supply without transport is subject to VAT in the country where the goods are located at the time of the supply, which in this case is a country outside the EU. So that means that it's not subject to VAT in the EU. So in the first situation, that would mean that the supply from the supplier to the platform is not subject to VAT in the EU. And as regards the second supply, if you use the IOSS, it will be the platform that charges VAT on the supply of the country of the customer, and then there will be an exemption upon import. And if it's the IOSS is not being used, the customer will pay import VAT in his own country. So the other situation where it applies, so the deeming provision also applies if there's an EU distance sale by or a local supply. That's also an option if the goods are, for example, in the Netherlands and remain in the Netherlands. So if there's an EU distance sale or such a local supply within the EU by a supplier that is located outside the EU. So, for example, if a UK supplier were to supply goods from the Netherlands to Belgium, it will be covered by the deeming provision as well if it does this via a platform. And as you can see here, the value of the goods is not relevant, so it applies regardless of the value of the goods, but it does not apply to suppliers that are established in the EU, because in that case it does not apply. So similar to the situation that I discussed before, there will be a supply from the supplier to the platform and then the platform to the customer. So the supply from the platform to the customer is the distance sale, which can be reported in the one-stop shop. If the platform opts to do that, and the other supply is a supply without transport, which will be subject to VAT in the country where the goods are located at the moment of the supply, which will be in the country EU country of departure. So in this case, you will of course have a supply that's subject to VAT in the EU, in the country where you have the stock. This supply is, however, being zero rated. This may, even though you don't have to pay any VAT, you may need to register and file VAT returns in the country of departure of the goods. So please, if you do this, you have to check in the country where you have the stock whether you need to file VAT returns there. I can say that if your stock is in the Netherlands, that you do have to register and report these supplies on which the zero rate applies. But I don't know how other EU countries deal with this. The provision only applies if the platform facilitates. So what is facilitating? It's the use of an electronic interface that allows a customer and a supplier offering goods for sale through the electronic interface to enter into contact, and that contact results in a supply of goods through that electronic interface. So that means if you only process payments or if you only do listings or advertisements, then you are not covered by the provision. There are some three conditions that if you meet those three conditions, you will not be covered by the provision, and they are explained very extensively in the explanatory notes on the new e-commerce rules by the European Commission. It goes beyond the scope of this webinar to discuss those today, but there may be a way out in certain situations. The platform is of course liable, but it may also depend on information from third parties, in particular, of course, the supplier. So there's a provision in the VAT implementing regulation that states that you have no obligation to pay additional VAT when you haven't paid enough VAT as a platform, if you depended on information from a supplier or another third party to declare the correct amount of VAT, and the information that you received was incorrect, and you can demonstrate as a platform that you did not know and could not reasonably know that the information was incorrect. And it's important to note that here the burden of proof is on the platform. So you should demonstrate that you did not know something and that you could not reasonably know something. And that means that you have to put due diligence procedures in place. You, of course, have to do some checks. And if you look at the explanatory notes from the European Commission, it also depends on the size of your platform. So if you're Amazon, we can expect more from you than when you're a small business that has a platform. So please also here, if you are covered by this provision, make sure that you set up your due diligence procedures in due time. I think it's over to you now, Richard, again, for some administration and practical issues.
Yes, thank you very much. And this is the last section of the presented content today. We are seeing quite a lot of questions coming in, so I want to give us a bit of time to be able to answer some of those, because there's some good challenging questions coming in on the Q&A, which is always good to see. So very briefly, just to cover some of the administrative and practical issues that you might need to be aware of as a result of these new rules coming in July. And what you'll see on this slide here is that there are 4 schemes potentially available to use as a result of these new rules. All of these schemes are separate, and it is possible to participate in more than one. So what you will see if you work from right to left, from left to right on this slide, you'll see the 2 existing schemes are being extended to encompass more supplies. And equally on the right-hand side of the slide, there are 2 new schemes which are being brought in to help assist with compliance. And remember, with these schemes, what you're effectively doing, if you are using a one-stop shop scheme, you are dealing with a tax authority in one country to help you comply with your VAT obligations in all EU member states. So that is what you're effectively doing. You're identifying yourself in one country, but still responsible for paying tax in all of the other countries. So just very briefly, running through these from left to right, you have the existing non-union scheme. At the moment, UK businesses are likely to be using that if they supply digital services to EU consumers. That is now going to be extended if you make other supplies of services which are caught within the place of supply rules. So it's potentially you can report additional supplies through there. Or if you're not using it already and you have multiple VAT registrations, that new scheme would potentially be available for you. The second scheme along is the union scheme. Now, this is an existing scheme which is available to help people manage B2C supplies of digital services where they're established in the EU. And what we're saying is from the 1st of July, that scheme is being extended to encompass the other B2C services which are relevant, as well as EU distance sales of goods. Equally, platforms can also declare local supplies using this union scheme. Thirdly, we've got the import scheme, the IOSS, and this is where you have distance sales of goods imported from third countries like the UK, where the intrinsic value of that supply of the consignment is €150 or less. This is a new regime which is potentially available and potentially quite helpful to UK retailers. And finally, on the right-hand side there's another new scheme which Madalena has talked about already, which is the special arrangement for postal and courier companies to help them pay the VAT that's due. So as you can see, the rules are reasonably complex and there is a wide range of regimes available for businesses to use. So it's important to make sure that you're aware of what they are and which one is right for you to use. And the final part of today is to just provide a very brief overview of some practical issues which we are already seeing for UK businesses from these rules. I should say on the next couple of slides, these are not exhaustive, but it is hopefully a useful indication of some of the issues which people are encountering. Given that we've got quite a lot of questions, I will just pick through some of these just to pick out some of the key ones. So for example, if you're making supplies of services, B2C services, and you don't use a one-stop shop, to manage that VAT compliance, you might end up having to file and pay VAT in various EU member states. Equally, we know that UK businesses have spent quite a lot of time implementing solutions to enable them to deal with the UK's exit from the EU. Those potentially being brought in from the start of the year to deal with the new trading rules. And it's really important that businesses have a look at the interaction of these new rules with any new regime or system or solution that they've implemented to continue with their EU supply chains. In some cases, the new rules might actually make it easier for you to comply with your EU VAT obligations. The third point just to cover on here is member state readiness. These reforms have already been pushed back 6 months. They were due to come in from the 1st of January this year. What we are hearing anecdotally is that some EU tax authorities are struggling to be ready in time. It's quite a big change to how you pay and collect VAT on quite a large number of supplies. And at a time when tax authorities are already stretched, some EU member states are struggling to be ready on time from the 1st of July. But that said, that is not to say that these rules will be delayed from implementation. Equally, you'll just have heard a short session there around the impact for platforms and marketplaces. There can be complex implications for businesses who are making supplies direct to their consumers, but also selling via marketplaces. So if you find yourself in that position, it's really important to map out the supply chain in detail and understand who's responsible for what. Another useful point to note is we talked about the existing schemes, the union and the non-union one-stop shop schemes. Registrations for those can only be effective from the start of a calendar quarter. So if you want to use one, you need to be ready for go live on the 1st of July. If you're not, you potentially face a delay in being ready to use those schemes. And the point just off the last slide is that you may need to be registered for more than one of the one-stop shop schemes, depending on what your activities are involving EU consumers. So what else might UK businesses need to think about? The first one in the top left is potentially very relevant. If you're going to use the importer one-stop shop scheme, so the IOSS, potentially as a UK business, you may need to find somebody to act in that capacity as an intermediary for you. If you're a UK retailer trading with the EU, and you've been trying to be responsible for the import of those goods into the EU after the UK has left the European Union, you might have already had some challenging experiences trying to find yourself an indirect representative. It is somebody who's potentially established in the EU and jointly and severally liable for any VAT dues. So it's not that attractive a role, and we aren't hearing of that many people who are offering those services at the moment. So again, if you want to use the IOSS and you want to find an intermediary, we'd recommend that you start early. I'll skip over the place of supply rules because I think I made those points reasonably clear during the B2C services session. So the next one is just around record keeping requirements. For example, the EU's record keeping requirements and timescales may be different to those in the UK. So to use the one-stop shop schemes, you'll need to retain your records for 10 years, which is different to here in the UK, where you're responsible for keeping your records for 6 years. Another key point to note is what are the implications of an underpayment? So if you have a VAT bill due through one of the one-stop shop schemes, if you don't pay that in full, you will proportionately underpay in all of those countries where you registered. So the money you give over to the member state of identification will be distributed proportionally, and potentially you have multiple defaults. And the reason we flag that is if you have persistent failings such as that under the one-stop shop schemes, it can lead to you being barred from using the one-stop shop schemes, which is potentially quite costly and burdensome from an admin perspective. And the final point just to cover off is if you're using a one-stop shop scheme to report VAT in an EU member state, you can't use the one-stop shop to recover any VAT that you incur in those countries. You'll need to use a separate mechanism for that. So those are just a few of the practical issues that we've seen already to date from looking at these rules. As I hope the last 45 minutes have shown you, these are fairly complex new rules coming in relatively soon. And they will impact UK businesses trading with EU consumers in different ways. It may be, for example, as a UK business, that actually you're not impacted at all by them, but it's good to know and to understand that. And what we're recommending to all of the businesses that we deal with is that you take the time to understand these rules and take the time to map out the impact on your business. And we'd recommend that you do that now, because if there is any changes that you need to implement, you're giving yourself some time to try and get those changes done before the new rules go live. So I hope that has been a useful summary for everybody on the call. As I say, we have allocated some time for questions. I thought we'd get some. We seem to have had quite a lot, so we'll try and get through as many of those as we can. If we can't respond to your question today, we will come back to you. And the good news is, because I have my colleague on the call, I can direct any hard questions your way, which is great for me. So I'll start at the top. I've got quite a list here. There's a few people asking here about this €150 threshold for the IOSS. Does that include VAT or exclude VAT?
It excludes VAT, so it's without the VAT.
Yep. Fantastic. So just to be clear on that point, the €150 threshold that we've talked about in respect of the IOSS is excluding any VAT due. I've got another question here. We've got a UK-based trader who's going to use the importer one-stop shop scheme. So does this mean that I need an intermediary in each EU country, or just one country who'll manage all of the EU?
Yes, it's a single VAT registration system, the IOSS. So that means that if you have an intermediary, an EU intermediary, and let's assume that this intermediary is established in Austria, I just pick a country, then you register for the IOSS in Austria, you file your VAT returns in Austria, or your intermediary does this for you, and then you will pay to Austria all the VAT you need to pay in the other EU member states. So you only have to find one EU representative in one EU member state who will file the IOSS VAT return in that member state for you.
Thank you. Yeah, and I think the key point here is if you fall within that bracket, it's all about the EU tax authorities just having somebody that they can go after if there's a VAT default. And when you're within the EU, all of the EU tax authorities cooperate with each other. So you just need to be in one country for that. And there is another question here, which is linked to that. How do we find out who will act as an intermediary? And I think the answer to that question is that it's likely to be quite challenging. Yeah. Is there anything you're experiencing in the Netherlands about who might be acting in the capacity of an intermediary for these purposes?
Now, I haven't heard from anybody that's taking this role. Even for example, BDO the Netherlands, but also some other VAT specialists that I know in the Netherlands. They have a fiscal representation. They do that in the Netherlands, but it seems that this, like you said, Richard, this position that you take is not one that you can take easy, because you will be responsible for all underpaid VAT, because the tax authorities will come to you. It seems likely that there are not too many parties wanting to do this. So it's I think, like finding an indirect representative for customs purposes, it will be very difficult to find one.
Yeah, and I guess the only other thing to add to that is you may actually see that if you have a very good relationship with your freight forwarder, they may act in that capacity, but we can't tell you definitively, unfortunately, on that front.
Yeah.
I've had a few questions just through the system where, which is probably one for me to take here, where we say actually UK business is acting. We sell the goods from the UK. We ask for the EU consumer to act as the importer of record for those goods because they're established in the EU. But we pay and discharge the import VAT and any customs duty liabilities on their behalf. Does the IOSS change this relationship? The answer is that the IOSS is optional. You can use it if you like, but it is only available for consignments of under 150 euros or less, sorry. If you are a retailer who's making some supplies of goods which are over 150 euros, some supplies which are under 150 euros, you could only ever use the IOSS for those that are under 150 euros. And as I say, just to reiterate, that is an optional scheme, so it's not mandatory. So there is a question here, just as a follow-up question there. We have a large range of products, both under and over 150 euros. Practically, are we supposed to split these lines out and report under the two different regimes? The answer is you don't have to, but you may wish to if you use the IOSS. We've got somebody here asking, if we choose to register in one EU country, is there any country that is better than others? That is a loaded question, but I will pass that over to you because we were talking the other day about member state readiness, for example, and who's best prepared for these changes. I think from a practical perspective, here in the UK, most of the clients that I deal with would either choose to register somewhere like Ireland, for example, just because similar business culture, everybody speaks English, they apply VAT in a similar way to us. But we do see people registering elsewhere, and the Netherlands is a popular destination. Do you have any views, Madalena, on are there any better countries to register in than others?
Yeah, I don't know. I know about the readiness of my own country, of course, and I also know that Germany and the Netherlands, of course, asked for another postponement until the 1st of January 2022, which was not without reason, because both countries are struggling to get the IT ready. The Netherlands has it ready, the IT, but it's it's a process where you can register and you can file your returns and you can pay the VAT, but everything and you can do that all digitally, but everything else is being done by hand by the tax authorities. And yeah, if something's done by hand instead of automatically, there may be more mistakes and there may be reason to contact you. So not to disqualify my own country, but if Ireland has their business better, or if that works better in Ireland, it might be maybe recommended to go there for a while. In the Netherlands, it's kind of an emergency track that they now have to deal with these registrations. And if it's too many, then of course doing the processing by hand, that will cause difficulties. So that's something to take account of. And also Germany is not quite that ready. So those are two countries which I know are struggling. But maybe all 27 are. I haven't heard from any other EU member states that they are struggling with this, but the Netherlands and Germany are.
Okay. There's quite an important question. We've got lots and lots of questions, and I don't think we're going to get through all of them. But as I say, we will come back to you if you have asked a question that we don't address today. Quite an important question that's come through here is, if I'm using the importer one-stop shop scheme, what checks are going to be done? You mentioned reduced checks when the goods arrive in the EU. What are those reduced checks?
Yeah, so you can use a special reduced data set to file your customs declaration. Customs is not my specialty, but it's a reduced set, so you don't have to report all the information that you normally have to report when you file customs declarations. And you will then provide your special IOSS number that you have obtained when you registered for the scheme. And that is being checked by the customs authority on whether it's valid. It's not being checked whether it's your number, so whether the name on the parcel corresponds with the number. It's only checked if it's valid, and it is of course because those goods could be imported in the name of somebody different than the person whose IOSS number is being used. For example, if the customer is the importer of record, it's being imported in their name, while the IOSS number is from is of the supplier. And also when a platform is the person that is liable to pay the VAT and uses the IOSS, then it will, you have situations where it's not the platform that's the one that's importing the goods, that it's either the supplier or again the customer. So you can, it's also impossible to check whether the IOSS number is indeed from a person that is involved in that transaction. So it's only being checked whether it's valid or not.
So actually that feels quite risky, doesn't it? If you do use the IOSS and you get one of these IOSS numbers, you need to be quite careful, I think, who you make that available to, by the sounds of it.
Yeah, it's a ticket to an exemption, which makes it, I think, very interesting for fraudsters as well. It's being advised to really be careful with who you give this number. And you, of course, need to give it to your logistics company, because they will be the one that's presenting the goods to customs. But yeah, you should be very careful in using this number. And it's also been stated in academic literature that these numbers have, for example, the numbers of the big players, they might be hijacked at one point in time, because if Amazon registers and it has an IOSS number and there are numerous sellers selling on Amazon, and Amazon needs to provide the sellers with those with that IOSS number, what's keeping them from not using the IOSS number if they're not selling via Amazon, if they have a direct sale? And the idea of the European Commission is then to block those numbers, but then again, that would also cause a problem, because then I'm using this number maybe as an honest taxpayer that did sell via Amazon, and then I'm getting refused the exemption. So it's the it's really a weak point in all. I think the weakest point in the system, and we will have to wait and see what happens there. But really be careful with as regards to whom you give this number.
And we have time for just one last question, which is quite a good one. It's come through a couple of times on the Q&A feed. Is what happens if I'm a UK retailer and I'm selling directly to EU consumers via my own website, but I'm also selling through a marketplace like Amazon or a platform like Amazon? Who's responsible for accounting for the VAT, and is the VAT going to end up getting accounted for twice here?
No, you don't have to pay VAT twice. So let's start at that. No, if you make a direct sale, you will be the one that's being responsible for the VAT. And if you sell through a platform like Amazon and the deeming provision applies, so you need to check whether the deeming provision applies, which depends on where you are established, where the goods are located, and may also depend on the value of the goods. But if it applies, then for those transactions that you have via the platform, you will not be the person that needs to pay the VAT. That it will be the platform that pays the VAT. But then you will have to make a difference also in your administration as regards these type of supplies.
Fantastic, thank you. I'm just mindful that we're coming up on the hour. We've had loads and loads of questions, Sue. So thank you to everybody who's listening for being really, really engaged. I think we are going to have to leave it there, unfortunately, because we're at the hour. So just a very quick thank you to you, Madeleine, for taking the time to join us today. It's been really, really insightful from my perspective to work with you over the last week or so, just to get to be able to draw on this EU expertise from our global network. So I really appreciate you investing the time in this.